to our YouTube channel, Trowbridge Law. I'm Gene Trowbridge with the Trowbridge Law Group, and today I'm going to talk to you about depreciation. I'm filming this during tax season, and so I'm going to have a couple episodes having to do with taxes in investing in LLCs and real estate, and I thought we'd start with depreciation. Depreciation is kind of understood, but kind of not understood. I think we know what depreciation is, but I don't think we all know what it does for us. So at the Trowbridge Law Group, we pride ourselves actually in helping people understand things that happen when they invest. So here we go. We're going to talk about understanding the role of depreciation. Well, first of all, depreciation allows for a write-off of the cost of improvements in real property over its useful life. And I put on the slide cost recovery. And that's technically what it is. Since 1986 in the code, it's called cost recovery, but everyone calls it depreciation, so I'll use that word. What the theory was in the Tax Reform Act of 86 is the IRS is going to let investors write off the cost of their investment in trade or business property or property held for the production of income over the useful life of the property, which they determine to be the period of time which it produces revenue. So if I buy an office building to put my law practice in, and I'm just the owner of the office building, I can take cost recovery on part of that office building, and the IRS has an idea of how long that office building will produce revenue. It's just a statutory number. There's no real relationship to revenue producing, because I can buy the office building and I have a useful life, then I can sell it to you and you can have another useful life. It just goes on and on and on. But for the purposes of cost recovery, there's a specific life. So it's trade or business property or property held for the production of income, which is what most of us are going to be working with when we invest in LLCs. We're going to be investing in an LLC that's going to own an apartment building, a mobile home park, a self-storage facility, maybe an office building. Who knows what it's going to own, but it's owned for the production of income. So once again, we can write off the cost of our investment, a portion of it, over some useful life that the IRS has determined it will produce revenue for us. So the first thing we would do is, after we go ahead and buy a building and figure out how much it costs, we have to allocate between land and improvements. Land, for the most part, is not depreciable. It's the improvements, it's the real property that we look to. So we have to do some allocation between land and improvements. And then we need to figure out the useful life. Well, there are two useful lives in real estate today, really. There's 39 years or there's 27 and a half years. And I'll talk about those in a minute. 39 is for commercial and 27 and a half is for residential. They figure that residential properties will wear out faster and will lose their ability to produce revenue faster. So they give it a little shorter life, which means you get more cost recovery sooner. Then after you know what the useful life is, we're going to calculate the annual write-off that you're allowed. And then that annual write-off reduces the taxable income from the property. So let's see how that works. Here's an example. The price of the property is $1 million. Okay, that's the first thing we have to establish. What is our price? Now, the next thing we have to establish is, what is our depreciable basis? Our depreciable basis will be determined by allocating the property price between land and improvements. There are a number of ways you can do that. Maybe you're having an appraisal on the property, and the appraiser looks at in the cost approach to an appraisal. It tells you what the land is worth, and it tells you what the improvements are worth. Another thing you can do, let's say you don't have an appraisal, is you can go to the assessor. You go to the assessor's records. It's probably the most common method of allocating between land and improvements. And if in your county, in your state, the assessor does a breakdown, you can use that percentage. Now, if you're building a brand new building, it would be easy, right? You know what you paid for the dirt and you know what you're paying to build the building. So there are a number of ways of allocating. For our example, let's just say that the assessor says there's 30% land and 70% for improvements. So that would give us 70% of the $1 million price is going to be our depreciable basis in improvements. Over the life of our investment, we're going to be able to write off that $700,000. The question is, over what period of time? So the next thing we do is we go to apply the useful life. And 39 years is the statutory useful life for commercial real estate. And it's straight line. So with one little exception in the first year, it's the same percentage every year. If you took 100% and divided it by 39, you'd get 2.56%. So 2.56% of our $700,000 would be our first year write-off, and every year for 39 years. At the end of 39 years, it would be fully recaptured. Now, if we're buying a different type of property, residential property, the useful life is shorter. Now, residential property has a definition. Residential property is where people live there on an average of more than 30 days at a time. So that sounds like an apartment building, right? That sounds like a rental house, but it doesn't sound like a hotel, a motel, a bed and breakfast. It doesn't sound like that at all. And that's the point. If people live in it, we're going to give you a faster write-off. And that would be 27 and a half years. So in a straight line approach, 27 and a half years gives you 3.63% per year. So if you took that percentage and over 27 and a half years, took it every single time, you would end up with a fully depreciated piece of real estate. And so you can see right now, if your goal is more depreciation faster, you always get 100% if you hold the property the full length of time, but you will get faster depreciation and a bigger amount each year if you buy an apartment building or something where people live in it more than 30 days at a time. One of the interesting things that I've run into in my world is senior housing. At one time, my mother was in a senior housing tower, and she was there constantly, full medical care. She had to be there all the time. Well, that was, she was there not because it was apartment building. She was there because it was medical. And so that was deemed a commercial property, where my father was in the adjacent tower and he could come and go. He was ambulatory and drove. And so that was an apartment building. So here we had two towers owned by the same people. One tower is 39 years because it was commercial. Another tower is 27 and a half years. We also run into that now in developments where here's a building. We have a client right now who's doing a building in Cleveland, took an old bank building. The first 3 floors are retail and office, and the top 20 plus floors are residential rental. So that building may very well have 2 methods of cost recovery applied to it. You'll have to check with the CPA or an engineer to figure out what exactly that is if you're involved in that type of an investment. So we have to determine the useful life, which depends upon how we use the property, either 39 or 27 and a half. And, mobile home parks have a little different thing. All the improvements that are underground in mobile home parks, that's 15 years. So it gets a little complicated. So there's a lot to learn. But right now we'll just stick with 39 and 27 and a half. So if I know that my apartment building has a $700,000 improvement allocation, I'll multiply that by the percentage. In the example I'm using, it's an office building. 33.63% gives us $25,410 of cost recovery each year. Now, what do we do with that? And here's what people are mistaken about. They think that that $25,000 loss is going to cover their income on their K1, their 1099, their W2. No, it's not. The first thing it does is it shelters the taxable income from the property, because that's what it's all about. You bought a property, you're going to recover the cost of that property. That's going to shelter the income that that property produces. So let's see what happens here. Here we have a property where it was $1 million property, and in the first year we're going to have $100,000 of NOI, income minus expenses. We get to deduct our interest, the interest on the mortgage, $60,000, and we get to deduct the first year cost recovery, $25,410. The ending result is that in this property we have taxable income. We're going to report $14,590 of taxable income. What did the cost recovery do? It sheltered the income from the property. This $25,000 actually sheltered $25,000 of the $100,000 that the property produced, but it didn't carry over to your income from other sources of income. So the rule is depreciation first shelters the income from the property, and then depreciation may shelter other income of a taxpayer subject to the passive loss rule. So if this cost recovery was greater and it turned the taxable income into negative, basically what we're doing is we're still sheltering the $100,000. Whether we can go and shelter other income is going to depend on really today the passive loss rules. And that's something we talk about in another YouTube discussion that I have called Understanding Passive Losses. So what happens at the end? You see, cost recovery is sheltering income. Okay, that's good. So it shelters income, but the law now says when you go to sell the property, all that cost recovery that you've taken has to be recaptured. Okay, it shelters income today, but creates an income that you have to report in the future. So let's say we held this property for 10 years. We were taking $25,000 a year. We'd have $254,100 of total cost recovery that we'd taken. When we go to sell the property, the first thing we have to tell the government about is if we have any profit at all, the first $254,000 we have to recover as cost recovery recapture. And then that is taxed at 25%. So we'd have $254,000 recaptured at a 25% rate. We'd have $63,525 of ordinary income tax. This is not capital gains. You don't get a 20% or whatever the current rate on capital gains is. You don't get that. This is recaptured as ordinary income. Kind of makes sense. When you're taking it currently, it's sheltering the ordinary income that the real estate produces. So you don't pay taxes on that. And more than likely, you're going to be in a higher tax bracket than 25%. So cost recovery is taken right now. Sooner is better than later. You get to take off the write off. You probably get to take it at a higher tax rate than 25%, but then you have to recapture it. So, in theory, there's a difference. The cost recovery you took today, time value of money, at a higher write off compared to the recapture you had in the future, 25%, a lower write off. Cost recovery is still a benefit for you. And here's what you need to know: you don't have a choice. You must take cost recovery, or the government will impute it on your tax returns. So it's a little complicated, but it's something to think about. What we're having right now in tax season is we're having investors and sponsors calling us and saying, hey, I generated a lot of cost recovery. My investors aren't seeing that cost recovery is sheltering their other income. No, it doesn't shelter their other income. It shelters the income on the property. The most egregious problem of this is if the sponsor took what's called cost segregation. And what cost segregation is, you don't just simply do the 70-30 like we did. You get an engineer or an accountant to go into personal property. As much, let's take a mini storage. It's a perfect example. What's a mini storage? It's got some concrete. It's got roll up steel doors. It's got a steel roof. It's got steel dividers. All that stuff is personal property. Out of a mini storage project, more than half of it is probably personal property in cost segregation. Now that can be written off over 5 years. So if that can be written off over 5 or 7, whatever it is, that gives you huge write-off the first year, really sheltering all the income from the project. But the question is, does that go and shelter other income you have? What we're finding is in cost segregation, more than likely, the losses can't be used because of the passive loss rules. So that's something I think you should also learn about. And so look for my YouTube presentation on understanding and working with passive losses. This is Gene Trowbridge from the Trowbridge Law Group and our YouTube channel, Trowbridge Law, saying thank you. And thanks for subscribing to our YouTube channel.